is talking about Roth IRA. Now, I'm going to assume for this video that you know the difference between a traditional IRA and a Roth IRA, or traditional 401k and Roth 401k. If you need information on what is the difference between them, reference. All right, so the age-old question: should I be contributing to a Roth IRA or Roth 401k, and or how much should I be putting into it? And it's always a tax question because it's different for everybody. Well, this video is going to help break this down into understanding your situation and should you or shouldn't you be doing it. So while you're working, right before retirement typically is when people, they've worked their way up through their industries or have changed positions, and they're usually at some of the top level pay that they are ever going to receive while working. And so traditionally speaking, saying defer as much as you can to defer in a high tax bracket, and then when you're retired, you take it out in a low tax bracket. And the Roth is the exact opposite. You don't get a tax deduction for putting the money away. So if you're at your peak earnings and you put money away, you pay taxes at potentially a very high tax rate. And when you get to retirement, and if your income is from all Roth, you might be in a very low tax bracket. And so it's the exact opposite thought process going on there. And really what you need to do and understand whether or not a Roth is right for you or not is to do a financial plan. You need a plan to find out, okay, I'm living on $6,000 of income a month, or $10,000 or $15,000, whatever that number is. When you get to retirement, depending on your age, you'd say, well, some of this might consist of Social Security. How is that taxed? Then, is there a pension that you will receive? How much is that pension plus your Social Security, and how far away? How much are we going to have to draw on the portfolio? Are we going to have to take a lot because we plan on taking a lot of vacations and other things? And that's another thing, is most people, they imagine getting to retirement, but they don't know what their monthly allocation is going to be, or their annual expenditures, to say, am I going to have to draw heavy, especially early in retirement, and take some trips and do some things that you've been putting off, remodeling the house, what have you? What are we going to do with that money? When are we going to spend that money? And are we going to have to pay taxes on that money? And so for some folks, it makes absolute sense to say the longer you're in your working career and the higher your income is to not put money into a Roth. That's traditional thinking. But a lot of times folks say, I would like to retire early, but in order for me to get health insurance, it's subject to what am I going to earn, and do I qualify for a subsidy? If you had money in a Roth, that does not count towards your income. And so we use Roth as different tools that allow us to maneuver and retire earlier, and give us an opportunity or places to pull from that don't drastically change our financial status early in retirement. So chances are, if you're a good saver, probably be doing a Roth. It's not from the traditional thinking saying, high income, I should defer while I'm in the highest income and then take it out at a low income rate. We should be thinking about other things that might affect retirement. So it all starts with doing a financial plan and understanding your income flows and whether or not it justifies leaving everything the way it is, making a few changes, should you have a Roth. The second part of that thinking is, for those that are married, a lot of times our tax status is based on married filing joint. Now there is a rare instance where they're each filing separately for whatever the reason, but most people do married filing joint. We love our spouses and we would do anything for them. Well, the IRS allows us to pass retirement funds from one spouse to another without causing a tax consequence of doing so. But they're smart because they know unless if you remarry, you are going to file as a single filer instead of married filing joint. Now they have you right where they want you. The IRS Now we'll say you have the same required minimum distribution and they paint you into a corner, so you have to take out the same amount of money, but instead of married filing joint and spreading the taxes over two people, you're spreading it over just one person and your taxes go up. So the second part of that is it's inevitable, death and taxes. How do we plan for those scenarios to make sure that we utilize and pay as little taxes over our lifetime? And the Roth IRA plays a critical part in that decision. So the simple answer is, for those that are in a low tax bracket, by all means, try and put away as much as you possibly can into a Roth, because tax brackets might go up in the future. We have to pay back our nation's debt, or at least be able to pay the interest on our nation's debt. Well, they could raise taxes, and that is an opportunity for us to exploit if we pay attention. So people in low tax brackets, absolutely put away money into a Roth. For those that are in their peak earning years, chances are, for unconventional reasons, you want to put money into a Roth. And it's probably more than what you had originally thought you should put away. For those that have always done Roth IRAs since they've been made available, depending on your account balance and how you have been investing, chances are you still probably want to consider utilizing Roths or converting more money into Roths once you get to retirement. Hope this video helped. We'll show some examples next.